Hi there, welcome to Kneppy Invest and welcome to another answers and replies video. It is Saturday, the 9th of August, 2025. Time is currently 9:24 a.m. So let's get stuck straight into it and look at a question from Funktastico. If you stop contributing super, does compounding effect still increase super balance if ASX 200 goes nowhere for 16 years, akin to lost decades between October 2007 and October 2023? And PTB Fund says, hopefully your super has significant exposure to global equities. The way I'd answer this is I'd still think compounding effect would be relevant even if the ASX 200 goes sideways, simply because of dividends. And a lot of companies in the ASX 200 aren't growth companies, and all they provide their shareholders is dividends. And that can be relevant for many investors because all they want from their holdings is a nice, reliable dividend every single 6 months or year. So even if the ASX 200 goes sideways for 16 years, you're still going to have a bit of compounding effect just because of dividends, but it won't be great. So I'd assume the average yield in the ASX 200 might be 3%, if that, maybe. I'm just guessing, completely guessing. So over 16-year period, if that is the average dividend yield, that would be your yearly return if the ASX 200 doesn't go down. So you're assuming that. So there's still a little bit of compounding effect, but not great. And that is one of the reasons why I prefer to have control over my super, because I want to invest in the companies that fits my strategy. And a lot of people don't have that control. All they get to decide is, I want my super fund to be more aggressive with my super or conservative. Anyway, so I do believe there are three goals when it comes to investors. Protect or grow your capital should be the number one goal. Protect your capital, particularly if your capital does get to be a pretty big size. And then finally, you want to have, or your capital to generate a passive income for you to live on, so you don't have to work. And that's the whole point of retirement and having a fairly large super. In that regards, it all depends on your investing strategy. So for instance, if you're a 21-year-old, you shouldn't be caring about income at this point. It should be all on growing your capital and then protecting your capital and then eventually generating a passive income. And also PT Fund makes us an interesting comment here about having exposure to global equities. So I would also say the ASX 200 tends to be more mature companies, less growth, and you do see much better growth companies in global equities, particularly when it comes to NASDAQ. And for me, that is where I prefer to invest in, because I'm looking for growth companies, because that's where you really see the effects of compounding take effect. Okay, so thank you for that, Funktastico. So I do think dividends plays a part when it comes to compounding. Okay, Chris and Caroline asked, what was that stock screener? When or where can we find it? Thank you. I'm assuming you're referring to my rule of 10. So what I'll show you is exactly what I use, and it's Fiscal.ai. Fiscal.ai, it's my own screener that I developed, and I'll show you how I developed it. So, in fact, I have it. In fact, I have like a few screeners here, and here it is, rule of 10 high quality screener. And if you go to Fiscal.ai, I'm not sure if you have to be a subscriber to use their screener, and you can add screener by criteria, and all you have to do is add, for instance, I only have 4 here, market cap. So all you have to do is type in market cap. In fact, let's do this from scratch. Why not do this from scratch? So let's do this from scratch. So let's go to the screener and we'll start a new one up. So there's a new screener. You add the plus bar, and here it is. So got everything's blank here. You got countries, industries, exchanges, add screening criteria. I thought also should mention that I excluded a few industries: oil, gas, consumable fuels, metals, and mining. And the other one was and I'll go back to the screen. Capital markets. That's just on my own criteria. You can include those if you really want to. So I should definitely mention that. And then you just go to add screener criteria. So market cap, and I set that as 100 million. And then what was the next one? Operating margins. Operating margins. And I set that at 10% and above. And the next one was return invested capital, 5-year average. I should also mention, that's the other thing. Operating margins is actually wrong because I wanted a 5-year average. So that's important. And they should have a 5-year average here. There it is, 5-year average. And the good thing here is if you make a mistake, you just get rid of. So I get rid of the operating margin. And now I've got operating margins 5-year average, return on invested capital 5-year average, and then in revenue growth, 5-year average or 5-year CAGR. You could do 10 years if you wanted. So I'm just doing 5 years. And then you just run screener. Oh, by the way, you need exchange as well. You need exchange. So ASX, and hopefully, if we run this screener, actually we'll go to NASDAQ. No, actually what we'll do here, and hopefully, so running it on the ASX, we have 23 hits, including CSL. Now, CSL did not get hit on the previous time I ran the screener, I think, maybe, I don't know. So let's just have a look to see if now this brings us exactly the same list. No, it doesn't. Oh, you know why? With the industries, you have to click on the exclude industries. There it is. I actually only include those companies or those industries, not exclude them. So make sure you do that. And now I should come up with 23. Oh, no. Oh, I forgot to put 10%. The whole point. This is the rule of 10. So revenue, 5-year CAGR, 10%. Operating margins, 5-year average, 10%. And return on invested capital, 10%. And now it should come up with 23. There it is. So that is the screener I've used, my rule of 10 screener, which I really, really like. You could also do a rule of 8 if you really wanted to, or you could do a rule of 10 for 10 years. In fact, that would make the rule of 10 even more significant. So revenue, operating margin, return on invested capital, 10-year average at more than 10%. And you can actually do that. In fact, I might do that. Try it. You probably get way less hits though. Okay, so hopefully I've answered your question, Chris and Caroline. Just Trim Kramer says, I don't know why I'm getting a match there. Has anyone heard of this saying, profit downgrades comes in threes? Sometimes companies simply go bust after the last one. Yes, this is a fairly common saying. Profit downgrades comes in threes. And I've heard this numerous times over the past 15 years since I started investing. So I'm just going to ChatGPT this. Apparently ChatGPT is new. GPT-5. So if I really, so I'm going to ask this question and put really. The idea that profit downgrades comes in threes is more of a market myth than a proven rule, but it's a widely recognized pattern that some people refer to. The notion comes from the idea that companies simply try to downplay bad news until they absolutely have to acknowledge it, often in stages. Here's why this happens. And I have seen this happen quite a few times, and probably the one example I can think of off the top of my head is A2 Milk, who issued 4 profit downgrades in a fairly short period of time. Yes, 4 profit downgrades back in, was it 2020 or 2021? And you can actually see what happened to the share price during that period. I still remember this because profit downgrades just kept on coming, one after the other, and then after the third one, we had another one. And I'm pretty sure this was either late 2020 or 2021. And of course, there it is. And yeah, so I can actually tell you exactly when this started, because just before they issued the first profit downgrade, a lot of the directors or insiders sold a lot of their shares. This was about a month before the first downgrade. And if I remember correctly, it would have been September 2020. That was the first downgrade, share price down 11%. At that point in time, share price was about $15. And there was another profit downgrade in December. So the first one was in September, second one was in December, third one was in February, and the last one was in May. So over, what was that, September to May, what's that, a 9-month period, issued 4 downgrades. And during that time, share price dropped from $16 or $15 all the way down to $5. Share price dropped 67% because of these for-profit downgrades. So you can just see it here. What happens to the share price and the sentiment? And after that, share price just kept on decreasing. And since then, share prices have been going sideways, although starting to trend a little bit higher. So yeah, this is a saying I've heard a lot. And I suppose I've seen it happen. King Consumer says, hello there. For reporting season calendar, check out Morgan's reporting season calendar. There you go. It can be downloaded by non-members, has over 100 companies with a link to their research overview. The thing I really find useful is they state both their and consensus earnings numbers, plus also give some commentary. That is really interesting. So this is one I haven't looked at. Morgan's reporting calendar. Download today. There you go. Okay. Oh no, you can click on it. So let's have a look at REA. Oh, this is I have to say thank you to King Consumer. I have not seen this before. This could be, I wouldn't say game changing, but this looks to be really interesting. Really, really interesting. So let's have a look at Vita, because they had a bit of a downgrade. Light and Wonder, nothing on the 8th of August, so they haven't got Nick Scully. So I haven't got every company here, but that's okay because this is quite in depth. And yeah, I like this. I like this a lot. Like it a lot. Like it a lot. Oh, thank you for this. I'm going to go through that later in the day. So thank you for that, King Consumer. So I love it when people give me something I've never seen before. And this is one of those cases. So that it definitely deserves a thumbs up. Okay, Fishbowl says, compared to other assets, asset class housing has one of the lowest rate of return over a long period of time. It ranges from 3 to 7%. You can only make decent money if you leverage by borrowing. That is actually true. And I would say technically, house prices should over time increase at the rate of wages in price. In fact, there's a price to income housing, and not now. There's ANZ has released a housing affordability rate. The price income ratio in the context of housing refers to the relationship between house prices and the income of individuals' houses. So technically, houses should rise at the same rate of wages. If they rise at a quicker rate than wages, then eventually housing becomes unaffordable to the normal person. And then we're going to have civil unrest, that sort of thing. If wages grow at a greater rate than housing, well, that'd be great. Anyway, I don't see that happening. So I think over a long period of time, we should see housing rise at the same rate of wages. People have tried to tell me, no, it's all depending on interest rates. But I would say everything else being equal, housing should rise at the same rate as wages. But you also have supply and demand. And right now, it seems like we're more interested in increasing demand than increasing supply. In fact, every single time a government comes out with new incentives to make housing more affordable for first home buyers, it's all about stimulating demand, not about supply. And if they stimulate demand, then house prices will increase. In fact, say for instance, first home buyer grants, say $50,000, immediately the price of housing will go up $50,000, even more, because it's stimulating demand, not supply. Anyway, so over time, price to income ratio should be steady. It should be flat because housing should rise at the same rate of wages. But it hasn't. In fact, there should be some images here. Here's one, houses. I'm not sure where that is from. That's Sydney. And yeah, house prices have been rising at a much greater rate than wages over the last 20 years. And that's why housing is becoming more and more unaffordable. And eventually no new home buyer or no one who hasn't got any rich parents with property will not be able to afford housing. They'll just be renting. Anyway, so eventually I think we'll have to see house prices either stabilize and wages catch up, or housing prices will have to fall if wages don't catch up. So that's how houses could catch up to wages, by falling. I'm trying to find a really good graph here. Well, this is a good one. Reserve Bank of Australia, housing price to income ratio going back 40 years. You just see it going up from 2 to 5. Yeah, so it's becoming worse and worse. And one of the reasons behind this is because politicians have so much of their wealth in housing. And so they don't want housing to drop. So they do all these measures to look like they care when they don't really care. They just want to maintain their wealth in housing. And so one of the best ways to get around that is to say, no, well, no politicians can have any investment housing or investments in housing. And then you'll see a significant change in their policies. I can tell you that much. Anyway, so sorry about that rant. Anyway, so, and it's actually true. You get returns in housing is not nowhere near as great as equity over the long term. Now, maybe over the last 20 or 30 years, it's been better than it should be just because of what we've seen, that housing has increased at a greater rate than wages, but that's going to come to an end eventually. And so for me, investing in property at this point, it may be good over the short term, but eventually it's going to turn ugly, I think. And by the way, I'll also mention, if you have a look at the richest people in the world, how do they get rich? Companies. That's how you get rich. Companies, not housing or property. It's developing, growing companies. Anyway, and our South African friend Anderson, always appreciate the continued coverage of Palladium. And one of the reasons I keep on looking at Palladium is because of Anderson. So thank you for that. Thank you for that. I am eCar says, thanks for replying to my question about stock allocation. I appreciate the suggestion. Just wondering, what if a stock like DroneShield, for example, rises rapidly and becomes 10 to 15% on my portfolio? I'm comfortable with the company's financials and recent contracts, but I'd like to learn in general, is it better to trim back to rebalance or keep holding winners? Now, this all depends on your confidence, I suppose, your conviction, your confidence and conviction on DroneShield. So you do say you're comfortable with the company's financials and recent contracts. So I'd say why, if you're really confident and you have high conviction, you've done research, why would you sell? Why would you sell? So, and the other thing I would say is, when you do have a look at the richest people in the world, they had a lot of conviction, really high conviction on the companies they have developed, and they put all their wealth into the one company. So very concentrated, and that's actually how they became rich. So the best way to become rich is to find a company and put all your wealth into that company, and you could also go completely bankrupt. But that happens a lot too. So the stories of the richest people is not full of people who've gone bankrupt, people who didn't make it, but there will be way more examples of that than the rich people. So I can't really give advice on your own situation. So this comes back to how confident, what is conviction around DroneShield. Personally, what I've done with some other companies that have run up a long way is I've trimmed a little bit, and then I've just said, hey, I'm going to let the rest ride. And that's done okay for me. So yeah, so there's a lot of ways to play this, but yeah, it all comes back to your conviction. How confident are you? And plus, holding winners is a great strategy. Peewee 4326, 2 takeovers I didn't understand. Mermaid Marine and Drop Suite. Can't really talk about Drop Suite, but definitely Mermaid Marine. 2 of my holdings that were growing strongly. Obviously, management had a lucrative future role in them. Yes. Yeah, Mermaid Marine was one of the weirdest ones. A really nice growth. I'm pretty sure, I forget exactly why I was so upset about it. There was not much premium to the company's valuation. And I think the management even said, well, we're cyclical companies, so share price could drop a lot, or the company could, go back to performing crappy, something like that. But I do believe that they were enticed by the takeover people to accept the takeover bid. So I can't really comment on Drop Suite, but I think this is a good reason why some investors love buying into founder-led companies, because more than likely the founder of founder-led companies won't just sell the company on a whim. And it seems like a lot of management do that on the ASX. They get a takeover bid and just sell. Just say, oh, no, we're going to accept this. And so I'm very happy that, who was it? Travel Holding said get lost to the people who was trying to take them over. Opportunistic bid. And they said, no, it's too cheap, get lost. Thank you for that, Pee-wee. Jason Lang says he loves my videos. Okay, let's move on. Okay, no. If I recall, you took a position recently in LDX around 6.6 cents. What type of stop loss trigger would you have on a stock like that? Maybe a trailing stop of 8%. In fact, there's a few questions about Lumos. And Gold Royal says Lumos smashed through to hit a new 52-week high of 8.7 cents, continuing its bull run, finished at 8.4. Maybe a period of consolidation coming for another leg up, likely 10 cents by end of month with CLIA study completion. Very compelling. And there was something else about TRG. So I'll just mention Lumix. So yeah, I did take a trade position in Lumix. This is an interesting one. So let's have a look at the chart. So one of the reasons I actually took position in this one is because I really like their announcement. So I can't look at. It was a fairly potentially massive deal if everything goes right, and that's a big if. So here it is. Where is it? Pivotal USD February DX agreement. And if I can't remember the actual numbers in it, but it was pretty big. Here it is. 60 exclusive agreement valued up to 487 million Australian dollars. So if everything goes right with this company, it's currently valued at 68.86 million. So everything goes right. Well, there's a lot of upside, potential upside. So that is one of the reasons why I thought, interesting company. It's also not a story stock. They actually are selling stuff, and they do have a little bit of revenue and what do you call it? Revenue. Ooh. Go Mika. Saw Mika at the top here. Didn't realize Mika was up 14.82%. Go Mika. Okay. So this company doesn't have a bit of receipts and revenue, but it's not cash flow positive, that sort of thing. Oh, they had a nice investor briefing, 30 pages. I should read that. So if you have a look at the most recent Appendix 4C released on the 21st of July, they were or produced $1.8 million in receipts and operating cash flow negative by 1.7 million. So if they didn't release that sort of announcement, this sort of Appendix 4C wouldn't have dragged me in, but it's just that announcement that dragged me in. And I thought the market wasn't really pricing in the potential. And then the share price did pop up on that day a fair bit, 144.83%. There was a little bit of selling on that day. You can see actually the selling continued in the next few days. But you can see the volume also went down significantly. So really, if I timed it to perfection, on the 22nd of July, share price went to 6 cents. And you can see very little volume on that day. And there wasn't, share price only dropped 1%. That was sort of the signal that the selling had come to an end. And in fact, the share price on this rally from there, from 6 cents up to 9.5 cents, we have seen higher volume coming in. That's exactly what you want to see. So share price has rallied pretty nicely for Lumos Diagnostics. Now, initially, I didn't have a stop loss initially because I did think the share price would eventually rebound. At this point, my stop loss, or my sell point, I haven't put it in yet. My sell position would be somewhere in there. I don't want to see this. There's a little bit of a dip on the 28th, 29th, and I want to see share price drop below that. And what I'll do is I'll raise this every so often. I could even put it there. So 8 cents, but I'm going to be a little bit more conservative with this one. Maybe not conservative. Yeah, conservative, and keep it down a little bit and keep it down to about 6.8. So even if I sell, if it hits that or just goes below it, I'd still make a small little profit. Maybe. Anyway. Okay, so that is your answer. What type of stop loss trigger would you? So usually in these sort of situations, so initially when I take a position, it's 10%. So look, if the share price drops 10%, I've made the wrong choice. But then once the share price rallies a fair bit like we've seen with Lumos, typically I just look for support and resistance areas. And I don't want to see the share price break through those support or resistance areas. That's what I'm doing with Lumos right now. And yeah, likely 10 cents by end of month. Oh, yeah, I'd say that's a pretty good chance. The other thing I'd also say is once the share price gets above 10 cents, I do change. In fact, when the share price gets above 10 cents, I'd probably raise my sell level to at least 9 cents. I want to see how much struggle it is for Lumos Diagnostics share price to get above 10 cents, because 10 cents is a significant psychological level. It is a significant psychological level. In fact, I'd say it's the most significant psychological level. We see changes in the way share price moves. So below 10 cents is every 0.1 cents, above 10 cents is every 0.5 cents. And a lot of times you see that as acting as a really significant resistance level. And so if Lumos just gets above 10 cents on strength, that's a really powerful move. Anyway, so I'd say it's a good chance it's going to get above 10 cents. And I'll have a quick look at TRG. Is this Trig? TRG? TRG. It's not coming up. What is Trig? Trig is TMG. Oh, I don't know. So I have no idea what TRG is. What I could do is Tiger's Realm Coal. That's TIG. Okay, so it could be a mistyping. Let's go have a look at Sensei 6011, who asks, thoughts on Audinate and future potential with 3 thumbs up, not thumbs up, thumbs up. So Audinate, I do own Audinate. We've seen the sales pullback in the past year because I think their customers had oversupply, and that oversupply should be run through in this year, and I think they're going to go back to significant growth in the next year. So this is a case where the share price has pulled back a fair bit because of that, and also revenues pulled back a fair bit as well because of that. And I think they're talking about financial year 26. I think that's the last time I heard. Now the chart still does not look good, so nothing for me in this chart is telling me to buy some more shares. Now, when I get a signal to buy some more shares in Audinate, I'm going to trade the heck out of this one, and I'm going to build my position in Audinate. Now, I'm trying to remember the last time they issued something of note, because for some reason I've got this thought or this memory that they do believe, they do think they're going to return to growth, not soonish, but a little bit later, maybe maybe in the second half. I forget exactly what they said. But I remember thinking, it's not now. It's not now. It's going to be a little bit later. Oh, so was it really the half year that I'm thinking about? It's like 6 months ago. For some reason, I thought they released something. Yeah, although the first half was impacted by excess inventory, that's the word, we remain confident in the fundamental strength of the business model. We continue to invest in our but I remember them saying that this overstocking, the impact of OEM inventory overstocking is largely factored into the full-year outlook. So I'm thinking not in this particular full year. It's going to be the start of the next full year, which we're in, I suppose, where we're going to see a bit of a turnaround. So maybe we're at that point where we should be looking for an Audinate sort of a trading update, that sort of thing, that things have started to turn around. So I'm very interested to see how they report for the year, but I don't expect an amazing result. I'm trying to remember, I'm pretty sure they mentioned this, and I thought that was not that long ago. Maybe it was their acquisition announcement. I would also say this company has a pretty good moat because their competitors, if you have a look at market share, Audinate's market share is going up and all the competitors are going down. So obviously their customers love Audinate's technology over their competitors. I have heard someone say they don't have a moat, which was interesting because a lot of things I've read, Audinate does have a pretty good moat. And for some reason that did not work. Okay, I have no idea. But I still remember them saying something along the lines of the recovery won't be anytime soon, but the way I thought was later in the year, if my memory serves me correct. And sometimes my memory doesn't serve me correct. Anyway, the chart, no sign of the downtrend coming to an end, but I think it is slowing. And I wouldn't be surprised to see that the low has been reached. And that low was reached in April at around about $5.30, but no trend yet in Audinate. And by the way, before this really bad year, negative year, the growth was pretty good in Audinate. Okay, I've already talked about that. Oh, Mr. Fantastic, profit upgrade from Austal today too. And there was also a government announcement. Yes, I did not include Austal in that particular day. Very close, but the share price didn't increase all that much. It did increase, but not all that much. And they did release 2 announcements on the one day. Yes, so yeah, approval of Austal as Australia's strategic shipbuilder and earnings guidance update, which was a pretty significant update, by the way. This was pretty good. But if you delve a little bit more deeply into it, the reason why this was a pretty good update or upgrade, so announced an upgrade to its unaudited EBIT guidance to not less than 100 million, previously not less than 80 million. So it's a pretty significant upgrade. But the reason for this is a finalization of the accounting treatment related to Austal's manufacturing facility for submarine modules, contract with General Dynamics Electric Boat. So it seems like it was just some sort of accounting treatment, not because the company is doing absolutely amazing, which they are, but it wasn't because of that. It was more because of an accounting treatment. So I suppose that's one of the reasons why the share price might not have gone up as much. So 5th of August, and by the way, the chart is looking fantastic. If you go back to the 5th of August, share price did go up, but it wasn't up a massive amount. And of course, there we go. So what day was that? The 5th of August? Oh, it went up 7.9%, 6.35% the next day and has pulled back. But this is a brilliant chart. I wish I was brave enough to get in this one when the share price broke out. And that was back September last year. Well, in fact, it went into an uptrend back in January 2024 when the share price was $2. So it's gone up threefold since then. And there was a little bit of a weak period back in this time last year, but the chart since then has been wonderful. And you're just buying the dips. So the 100-day moving average and the 25-day moving average has acted as support. And this is actually the chart of a share price in an uptrend. You can see share price doesn't go up in a straight line. Have these dips, the dips. Hence, buy the dip. Okay. Oh, Yakitorio Taku. Can you please do a special video where you go through an annual report of a company in depth, a start to finish sort of thing? Maybe Telix. I bought the dip this morning and also during the recent dip like 2 weeks ago. Thanks. This is a bank video. So I'll do this. I'll do this for one company that releases their results this August, and then I'll record it, and then I'll release it sometime in September and or October. No, not and or October, because I won't release it twice. So wait out for that video. Maybe it won't be on Telix, but definitely on one company. So maybe 10 to 15 minutes of looking at an annual report. Well, maybe not the annual report, but financial results. Sometimes a company releases their annual report when they release their financial results, and that is their financial results. But sometimes a company releases their annual report well after their financial results. So typically an annual report is not price sensitive. If you don't believe me, let's have a look at Austal. Let's have a look since I'm there. Let's see when Austal releases their annual report. In fact, we can choose announcement type, annual reports. Here we go. So these are not marked price sensitive. So 30th of August, 31st of August. So it looks like they do release this when they release their financial results. But if we go to 30th of August last year, and what we'll do is we go to all announcements. We go 30th of August last year. Whoops, I'm going well past it. Yes, so they did release, so their annual report was their financial statements. They released Appendix 4E, annual report results announcement, 4-year results presentation, and Appendix 4G. In this case, I would look at the annual report because it has the financial statements in there. I'm trying to find a company that release annual reports separately. So I'm just going to pick one. Pick one at random, CSL. And we'll go back last year. Just trying to see when they release results. Oh, yeah. So, for instance, CSL released full-year statutory accounts, 167 pages, on the 13th of August, but no annual report. And I'm hoping they release the annual report later on. And the annual report was released. Well, looks like that was the annual report. But the previous year, they released it on the 2nd of September. So just after they released their results. In fact, if we go back, sometimes a company will release the annual report yeah, it looks like I can't see any annual report for CSL. Let's go to another company. What's another company? BHP. Why not BHP? No, not BHP. We'll go to another company. Pro Medicus. Why not Pro Medicus? Hello, anyone home? Where's all the announcements? Oh, this is getting annoying. Okay, I'm going to move on to the next question because for some reason nothing is working. Article Bureau says, is it too late for a buy on NextDC NXT? Let's have a look at NXT because for some reason market index is not working. And I bet nothing's working. Ah, there it goes. Now at least trading view is working. But for some reason, market index has stopped working all of a sudden. And of course, ComSec is in a maintenance halt, whatever you want to call this. It's going to be in this halt until 12:30 p.m., so another 2.5 hours. And nothing is working. Is it too late for NextDC? Absolutely not. Well, all depends. All depends, I think, on the reasons for why you might want to buy. So why do you want to buy NextDC? Is it for the long term or is it just for a trade? So that is probably the first question. Now, for a trade, this is a very slowly developing uptrend for NextDC. Now, the share price has rallied off the low, and I think, and that was back in April, and I think the market was becoming overly pessimistic about data centers for some reason. I don't understand why. You see a lot of data center companies share price drop a lot, start of 2025. No reason behind it. AI wasn't going away. The whole reason why everyone initially was excited about these sort of companies was AI, and that theme hasn't gone. That theme hasn't changed. Anyway, so I think that definitely these sort of companies were significantly oversold back in April or start of this year, and we have seen these share prices of these companies respond. Now, I listened to a podcast the other day with Rudi. I think it was Livewire. Rudi Livewire. He's really bullish on NextDC and any sort of what do you call it? Data center type companies. Here it is. Yeah, Rudi, it's not a bubble. AI's next winners and what investors are overlooking. Yeah, so he's really bullish on NextDC. In fact, in this article, or this podcast or article, he mentions the majority of investors don't understand NextDC. In a way, I suppose they don't. Here we go. He's a long been backer of NextDC, Goodman Group. He also loves Technology One, Zero, and WiseTech. So in a way, I do like that he has a fairly high opinion of some of these high quality companies like Technology One and WiseTech. But he's really been bullish on NextDC because of data centers. Even Goodman Group data centers, that sort of thing. And then, yeah, market index has just gone, there we go. NextDC is not profitable. That's, I think, the reason why most investors just don't understand NextDC is because it's not profitable, because it's building its infrastructure out. It's really building its infrastructure. But even then, if you listen to some other people, I'm trying to remember who had said, even then, they're a little bit different than infrastructure companies, because within their infrastructure, they can actually increase the revenue, if that makes sense. Anyway, so the main answer to this question is, why do you want to buy NextDC? Is it just a trade, or you do think there is long-term potential for this company? If there's long-term potential, yeah, maybe now's a good time to buy. I do think over time the share price will increase. Has a good chance of increasing. I shouldn't say will, but has a good chance to increase. And the main reason behind that is data centers, increasing AI, and even if I look at the, why is nothing working today? Sometimes I just have to press reload. So this is the weekly chart. No, that's Austal. Oh, it's just sometimes it's annoying. I wish I was at my old place, had no issues with the internet or anything like that. I'm pretty sure this is the internet. If you have a look at the weekly chart for NextDC, so this company has not been profitable ever. And you just see the valuation of this company just keeps on climbing, because it's building out the infrastructure, keep on building out infrastructure. And in fact, if you have a look at this chart and include the 200-week moving average, you can see this is actually a chart of a high quality company. And where the share price dips below the 200-week moving average is a great time to buy. Last time that happened was recently on this dip back in April. So this is just a bit of negative sentiment when it comes to data centers, a weird shift in sentiment that I think eventually will shift back to being positive again. And the previous to that was back in late 2022 when it came to increasing interest rates, because these sort of companies' valuations should be affected by increasing interest rates, because most of the profits are well into the future. So that sort of made sense. This little dip did not make sense. Anyway, so share price is now just above the 200-week moving average, but yeah, that was a time to buy. But I'd still say now's a good time. Yeah, but it all depends on your view and the reason why you're buying. Now, since we've got Pro Medicus, I'm going to see when they release their annual report. I just want to get in a situation when a company has released their annual report at a significantly different time than their full year results. So here we have Pro Medicus. No, they released at the same time. Well, there's cases where companies release their annual report at a different time than their full year results. I'm pretty sure. Okay. You know what I could do? When a company is required to release annual reports, yes, within 3 months after the end of the financial year. So July, August, September. So by the end of September, there it is, by the end of September. So they have to release their results by the end of August, so 2 months, and annual reports by the end of September. So that's why sometimes there's a bit of a difference. Okay, there we go. Okay, now on to SAF 99681. Despite a chart looking good, such as Pro Medicus, would you still look to sell a portion of your holding due to it being overvalued, or do you only sell when you get a signal? Actually, I've done this with Pro Medicus. I have taken profits. So I did trim a little bit, and that's it. No more trimming when it comes to Pro Medicus. And I don't want to fall into the trap of completely selling out because I think it's overvalued, because I know so many people have done this. In fact, so many people have completely sold out Pro Medicus at a much lower price. And the question becomes, why? Yeah, why? And this is what I would have done in the past. If I thought it was significantly overvalued, completely sell it. And then I'll see quite often the share price of a company just keep on going up. So I've not done that with Pro Medicus. I did trim a little bit, but I'm maintaining the rest. No reason to sell out of Pro Medicus just yet. In fact, maybe ever. Anyway, so that's what I do now with my high quality stocks. If I do think they may be a little bit overvalued, I might trim a little bit. And if I think they're getting too much of my portfolio. I might trim a little bit. Now, for instance, Shopify is now my biggest holding, and I'm not even thinking of trimming that just yet because I think the runway of growth for that company is decades. Medicus, I think it's decades as well. But even though it is overvalued, I'm not going to sell anymore. It could remain overvalued for the next 10 years, and the share price could still quadruple from here. Oh, by the way, the other thing I should mention is for my high quality stocks, I don't use technical analysis at all. No technical analysis. It's all based on valuation. So that's another thing that's very important here. So I only use technical analysis for low quality companies. Or I should also mention, I will trade some of my long-term holdings, my long-term holdings, but I trade around my long-term holding, if that makes sense. So I will trade those companies. For instance, right now I am trading Neuron Pharmaceuticals. So I have my long-term holding and I'm also trading Neuron Pharmaceuticals, but that's completely different. I'm just trading that using technical analysis. But for the long-term, yeah, I don't use technical analysis. That's a different thing. What I'm doing with my long-term holdings is I look for any sort of change in the structural position of the company. So for instance, maybe they've stopped growing. Maybe, they stopped growing and there's no potential for growth in the future, that sort of thing. Or maybe they've got new management and the new management wants to go into a completely different direction. Who knows? Maybe some new management come into Neuron and they want to get into Bitcoin, something like that. That's when I might completely sell out. So it's not based off technical, it's based off other reasons. And it comes back to the reason why you buy into a company. So when it comes to technical analysis, it's signals, technical reasons. But when it comes to my long-term holdings, for instance, Medicus is just, they are growing, winning new contracts, they're growing, no reason to sell out. Nam says, did you end up buying Qoria, even though it didn't pull back to the price you wanted? No, I did not. No, I did not. Have a look at Qoria's chart. It has not pulled back. In fact, the share price has increased. Was it 7-8 days in a row or something like that? Even more than that. But there's one little bit of a dip. So this is definitely an interesting looking chart. So I've been waiting for the share price to pull back, but it hasn't. And look at the volume. So really good volume coming in. So this is a case where what I should have done is, I've thought about this, what I should have done is when I got the breakout signal, just take an initial position. And if the share price does pull back, then add to my position. And that way, if the share price doesn't pull back, I've got my initial position and the share price just keeps on rallying. I'd be shocked if the share price doesn't pull back eventually, or if it doesn't pull back, goes sideways. I would also say this is significantly overbought. Maybe not significantly. Let's have a look. It is. It hasn't been overbought for ages. But sometimes a share price or the shares can be overbought for a long time. So I think one of the reasons why there's just so much enthusiasm in this company right now, some people have been saying it's the next Life 360. Anyway, that's Qoria. And yes. Bill Wharton says, Charter Hall, Long Wale REIT, that is one strange name. Well, it's actually not, if you break it down to what it means. So Charter Hall is the sort of like the asset manager. So you can actually buy Charter Hall itself, and they get money from all their managed REITs, like Charter Hall, Long Wale REIT. So REIT is real. What does REIT stand for? Real Estate Investment Trust. Real Estate Investment Trust. I'm going to something like that. Real Estate Investment Trusts. I didn't say the S. So what about the rest of it? Long Wale. Well, Wale is actually spelt without the H. So it's actually W-A-L-E, and it's weighted average lease expiry. Lease expiry, fairly important for REITs. And long means the weighted average lease expiry is a long time in the future. And I'm pretty sure that is what Wale stands for. Weighted average lease expiry. REITs. Yep, Long Wale REIT. Exactly. What is Wale in REITs? Weighted average lease expiry. What did I say? Did I say that? Weighted average lease expiry. A metric used to measure the tenancy risk of a particular property. So it's very relevant for REITs, weighted average lease expiry. In fact, if you have a look at results of any REIT, they will mention what their Wale is. So let's have a look at Charter Hall Long Wale REITs. So even though I don't have much interest in REITs, although you could say they're cheap now, I still understand some of this jargon because I had a look at these. I had a look at REITs a few years ago. I just want to understand REITs. And let's have a look at the presentation for Charter Hall Long Wale REIT. And one of the metrics you do look at for REITs is Wale. You also look at, there's a few other things that I forget. Here we go. Oh, NTA, you look at NTA per security. Here we go, 9.3-year Wale, long-term income security. Balance sheet gearing, always look at that as well. Earnings per share, yeah, whatever. Here we go. Oh, no. Financial performance. Distribution per security, sort of like dividends. So you look at net tangible assets, very important. Oh, weighted average cost of debt. Sometimes we'll have a look at that. Not that I look at these companies all that much. Also like to look at their what do you call it, their tenants. So for instance, they have Australian Red Cross, Brunswick Hotel in Brisbane, Ingham's portfolio, maybe. So Ingham's is a big client of this company. They also usually have nice pictures of their property, like Geosciences Australia, Canberra ACT, Australian Border Force, Department of Defence in Canberra. So sometimes I do like going through these, and I like these little slides. Number of properties, so 510, property valuation, weighted average capitalization rate, occupancy, which usually is fairly high, 99.9%, and there's Wale. The one thing I was thinking about the other day was, if the average lease expiry is like 10 years, does that mean if we do go through a period where property goes bonkers, does that mean they're stuck in with, for the long term, stuck in these leases where they can't increase the price? I don't know. Do they have capabilities to increase the rent? Because maybe Wale, a high Wale, is actually not beneficial to a REIT. I have no idea. Anyway, that's that. Bill Walton. Fishball says, "Hi Kneppy, thanks for mentioning REH. SKS Technologies is one, or in one of your recent videos. After doing some research, I feel very comfortable holding it. Any reason why you think Pentanet isn't trading up? Large debt, or are there more to it, you think?" Interesting. Yeah, Pentanet is an interesting one because did I do a video on Pentanet? Let me have a look. Pentanet. Yes, I did include Pentanet in my Appendix 4C video series. So look out for a mention of Pentanet towards the end of, or middle of, I think it's probably going to be released in the middle of September. In fact, I can tell you right now, if you just hold on. Now, these dates aren't set in stone, but I do have all my bank videos here. Some don't have thumbnails just yet. And in fact, how many videos? No, I've got to actually filter visibility, schedule, and currently I have 55 videos scheduled. There you go. And I can tell exactly where currently I have Pentanet released. Here it is. So currently it's scheduled to be released on the 15th of September, alongside Global Health and My Eco Group. So I do talk about Pentanet there. So have a look out for that video. Have a look out for that video. I don't remember talking about their debt though. In fact, let's have a look to see if they have much debt. I can't remember this company having any debt. So have a look. They are operating cash flow positive. I'm pretty sure they're free cash flow positive as well. Or just slightly free cash flow negative. If we go to section 7, no, they don't have any debt. Well, they do have debt, $2.1 million of debt, which is not too much. Although this company is not big, it's market cap of $12 million. Anyway, I do think it's cheap. And by the way, this is the chart. And yeah, the market just doesn't care about this company. Share price did respond really good when they released a really good Appendix 4C in January, but since then share price has dropped, even though they are operating cash flow positive. And you actually see the share price going up and down in waves, but the highs keep on lowering, which is the definition of a downtrend. Okay, so that's that. Roger Don says, hi Kneppy, what do you think of the chart on SPG? Seems recovering after the big dip post relisting. So this is SPC Global, I'm pretty sure, which owns some food stuff. SPC Global. Yeah, the share price has been or had been in a big funk. I haven't seen this chart recently, so let's see what it looks like. And of course, trading view is just, there we go. With my dad back now, I'm hoping, because he was talking about getting fiber to the premises, and I'm pretty sure that's what's happening here. It's fiber to the node, and all the neighbors are using the internet right now, which makes it really slow here. Anyway, so they relisted. Is that right? Share price has dropped a lot. Yeah, share price has dropped from $1.50 when they relisted down to 44 cents. So the share price has just collapsed. Now, it does look like the share price has found a floor. That floor would be around about 30 cents. And it does look like the share price is trying to move up. I personally would just wait to see how this company reports. Have they released any sort of updates? Let's have a look. Business update, merger delivers positive results on the 6th of May. 6th of May, and yeah, the share price actually did respond off. That does look like that was, I wouldn't say a trend killer, but that did actually increase a little bit of interest or introduce a little bit of interest to this company, because share price did rally on that day, and in fact, it looked like the rally the previous day. Some big volume came in. So it looks like that was or did put a floor to the share price and the downtrend. The other thing I'd mention here, just by looking at this, share price has just got above those highs. Look at that. So I'd put it right there. So just by looking at that, share price is now at, what's that, a 4-month high? So definitely the chart does look better, And we also saw the share price, when it broke out above that level, there was high volume on that day. We saw share price pull back a little bit on Friday, but it remained above that breakout level. So chart definitely looks better for SPC Global. Oh, Sensei says, what made EPX, EP&T Global share price go from $1.52 mid-2016 to getting delisted, then relisted mid-May 2021 at a share price of 19 cents? Company was founded in 1993 and 71 employees in 2024. Trader Hoop says, I know nothing about the company, but don't confuse share price with market cap. And then Trader Hoop also said, just looking back at announcements, the SOI in the 2015 annual report is around 70 million. However, more importantly, the EPX back then looks like it was taken over. So that entity was a completely different company to the company which listed in 2021 and was assigned the EPX ticker. Kneppy has warned us before about another company that we need to ignore the chart for before it's listed date, because the historic trading view data was for another company. Seems to be the situation here. So let's have a look at market index. So market index says EPX, formerly EP&T Global. This listed, they should have it here, listed May 2021. There you go, May 2021. So everything before May 2021 might be a completely different company. And maybe they were originally listed on the ASX and then relisted. But I would, oh, by the way, you could look at the prospectus. Have a look at the prospectus, and they should have a company overview. And yeah, you can see, I know the internet is really slow just because the prospectus is opening up really slow in market index. Usually opens up like that. And it is Saturday morning, and we have really old people living around here, and they're probably all on the internet trying to find when the next bowling tournament is on or something like that. So if you have a look at the overview, they should have a list of index. Here it is. Company overview 37. And they should have, here it is, Company overview. Founded in 1993, so it has been around for a while. In fact, yep, Sensei is right. Founded in 1993. I just want to see if they were listed before or if this was an absolutely new listing. It looks like they're not mentioning it, just they were listed or were founded in 1993. There goes, yeah, nothing yet. Another thing you could do is EPX hot copper. This sometimes doesn't work, but sometimes it does. What we do is we'll go to old hot copper and okay, so in hot copper, it does go back. So we've got 2010 here. So there was a company with a ticker code EPX in 2010, and we can just have a look at what this company was called. I'm just going to see if there was any interesting announcements. Investor meeting presentation. So it's called Ethane Pipeline Income Fund, which is, yeah, completely different, I think. And that had the ticker code EPX. So completely different, completely different. So I'm just assuming what is it called? EPX just got into the ASX, and this was their listing day, May 2021, didn't delist, completely different company. And sometimes you will see the same T code for a completely different company. And sometimes that's, you can see that in the trading view, they'll have this, they have a massive gap in the chart. Well, not the gap, but a different, what's a really good company? Maybe even SPC Global, yeah, maybe. No, that's not a good one. What's a really good? Okay, I can't think of one right now. I can't think of one right now. Anyway, so that's that. Jazz and Tails says, hi, thanks again for your commitment to your channel. Learned so much. Thoughts on Urbanise. Quarter report looking pretty good. Has a partnership with NAB. The chart is looking interesting. And funny enough, Urbanise is in my Appendix 4C video series. And I will be releasing the video on Urbanise later in September. So look out for that on Urbanise. And the chart does look interesting. That's one thing I did pull away from Urbanise, was the chart looks interesting. Highly operating cash flow positive. And yeah, the chart has been sort of in an uptrend for a little bit of time here. So just waiting for TradingView to update. There we go. So definitely the chart looks interesting. Maybe you could say liquidly traded, but yeah, interesting company, Urbanise. It's been around for a while on the ASX, but this is really the first time I've taken notice to that company. So look out for Urbanise later in September. Jack says, can you please do a chart on MinRes, Pilbara and ZIP? Do you think they are on uptrends? Definitely ZIP is. So let's have a look at the trends or the charts for all these three. So MinRes, this one might be turning. This one came on my radar the other week. And of course, don't want to get rid of that. Oh, this one, yeah, this one, I think MinRes definitely has signs of this moving into an uptrend. So definitely the downtrend has come to an end. We've had a moving average crossover. Usually I put these lines here to signify if the share price gets above this level, I'd say the share price is now moving to an uptrend. And we're seeing higher highs, also seeing higher lows. So MinRes, uptrend. So definitely the start of a potential long-term uptrend. It could be short, it could be long, it could be next 5 years. Share price of MinRes moves into an uptrend. So this is definitely a potential trade. Pilbara, not sure about Pilbara. I knew MinRes definitely has that potential of being an uptrend. I'm not sure about Pilbara as we wait and wait for TradingView. Oh, This one has potential. Pilbara, definitely moving. Share price up 9% on Friday. Has the potential of moving into an uptrend. So very close with Pilbara Minerals. And ZIP is definitely an uptrend. Yeah, very confident about this one. So with Pilbara Minres, these are starts of uptrends or potential starts of who knows how long the uptrend could go on. Now, ZIP has been an uptrend for a while. Not only that, the share price is very close to the recent highs we saw back in December 2024. I am trading ZIP, by the way, reminded me. So I bought $1.75 and it's nearly doubled since I traded on a trading update in April. Just after, remember the Trump tariff debacle? So I just bought just after that. Anyway, so all three charts look pretty good, particularly Minres and Pilbara because potential start of uptrends. So that's when you want to get in. Minres and Pilbara. Oh, Eli Lilly share price went down a lot overnight because of phase 3 test results of orforglipron, a weight loss pill they make. So the panic and sell off, probably a good time to buy Eli Lilly. Let's have a look at Eli Lilly. Eli Lilly overnight because I haven't had a look at this yet. So share price had pulled back. Chart had started to look pretty ugly, although in saying all that. Just take your time at trading view. Yeah, share price pulled back another 2.4%. I don't like this chart. The daily chart. Weekly chart. Now, if you actually put in the 200-week moving average, now if you say this company is high quality and just by looking at this long-term chart, if it updates, because trading view is really slow, the time to buy this company is when the share price hits the 200-week moving average. And that's been true since 2011. So it's hit the 200-week moving average 1, 2, and now 3, almost 3 times. So this could be a good time to buy Eli Lilly. Just based off that. Stu Percy says, I made a good point. Nothing to do with fitness. It's conditioning. Do the same thing every day and you'll just get really good at it. Well, I've got a bit of an update here. So what I've been doing the last 3 weeks, actually 4 weeks now, I've been going up this mountain. First time I went up twice. The next 2 times I went up 3 times. And then yesterday I went up 4 times. The last 3 times I went up, my legs were sore the next day. My calves were sore, particularly my calves. My thighs were sore last time. Today I woke up after going up 4 times and my legs are fine. So my legs are now conditioned to do step climbing, and go up a mountain 5 times. In fact, what was it? Elevation gain yesterday was about 1,500 meters, maybe 1,400 meters, I forget now. So I now know my legs are ready. My legs are now conditioned to climb up mountains. But I have to maintain that conditioning. So I'm going to have to go back and climb this mountain again 4 times because I want to make sure my legs remain conditioned. So excellent point. Nothing to do with fitness. It's all about conditioning. And I've got another little story. So when I came back from America in 2005, I did the City to Surf, 14 kilometer. I ran maybe 1 kilometer, then I walked the next 13, and I could not walk for days because my legs were not conditioned to do that sort of thing. And now I can walk 11, I actually do walk 11 to 12 kilometers at least per day. Then I run some, run 24 kilometers. Some days I run 16 kilometers. So my legs are conditioned to do at least 11 to 12 kilometers of walking a day. So it's all about conditioning. I wouldn't call myself fit. It's just conditioning, what your legs are used to. Historic, could you share your thoughts on SPP for Liontown today? Why the share price didn't go down? I'm thinking based off Pilbara, share price rallied 9%. That could be a reason why. What about core lithium? Let's see. Did core lithium go up significantly? No, it did not. In fact, it was flat. I'm not sure why Pilbara went up a lot. I'll get rid of that because I'm not trading core lithium anymore. So let's have a look at Liontown. Share price, in fact, rallied. Share price of Liontown rallied. Now, based off Pilbara, I would have said there was some positive sentiment in lithium yesterday, just based off Pilbara. And yeah, usually you do see the share price of a company drop if they do capital raising at a discount. And Liontown was at a discount, if I remember correctly. And we did see some buying coming through today. So maybe just some positive sentiment in lithium. That's why. Maybe that's it. But an interesting day. Oh, the lithium market is finally over, or is it? Latest demand, supply, and price drivers plus ASX lithium stocks to watch. When was this released? This was released 2 days ago. There you go. And that's all I'm going to say about that. I'll just say maybe a little bit of positive sentiment in lithium is the reason why the share price didn't go down. Just Jim Cramer. The final 2 comments from Just Jim Cramer. Super Retail and IDP Education, too late to jump on. Let's have a look at the charts of all of these. Now, Super Retail, I think this depends on your thoughts on retail. I do know there's a belief out there that with decreasing interest rates, these sort of companies you should be buying because everyone's going to be buying stuff because their mortgages payments are going down. Well, this chart does look interesting because share price is in an uptrend, but you can see the amount of volatility in this company over the past year. It's, wow, look at that. For me, I wouldn't be interested in this at this point, although the chart's looking pretty nice. Now, in saying that, the volume has been decreasing, which I don't like. And the other one, IDP Education, I noticed the share price of this one went bonkers the other day, or maybe it was a few days in a row. Maybe just because it's oversold. And would I be interested in IDP Education? Let's have a look. No way for this one. Not for me. This could be just one fund manager getting interested, buying some shares because they think it's cheap, but this is not the chart I am keen on. Not the chart I'm keen on. The only reason I might be keen on this is if I think it's good value at these levels. So definitely not technical reasons. If I think it's good value at these levels and there's questions about that. So it all comes back to your conviction. Okay, and finally, Just Jim Cramer asks, Kneppy, out of all the stocks in Saturday's video, which is today, please choose a favorite stock. Thank you. A favorite stock. Favorite stock out of all these companies. Favorite stock. Pro Medicus. Has to be Pro Medicus. Has to be Pro Medicus at this point. Yep, Pro Medicus. So everything being equal, Pro Medicus. And the reason behind that is if you ask me the highest quality companies on the ASX, Pro Medicus will be near the top of that list. Whole reason why it's significantly overvalued, if you look at the PE ratio, is because it's a really high quality company. It's a really high quality company on the ASX. So out of all these companies, it's probably my favorite stock. Would I rush out and buy it? No, because the valuation is so rich. So things have to go right for this company for the share price to keep on going up. Maybe not right, but things can't go wrong. If there is a slightest hint of something going wrong with Pro Medicus, share price will drop. But at this point in time, it's my favorite stock. And in fact, I would say it's one of the highest quality companies on the ASX. Now, if I look at the other high quality companies on the ASX that I'm thinking of, I wouldn't buy it out of those because of the valuation. I'd probably be thinking about buying CSL. Anyway, so that's it for this video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.